Welcome back to F.A.C.E, Adem.
Hey,
Breaking
Dale, you
up.
able to hear?
Yeah, you're breaking
Sorry.
up a little bit. Now you're better.
Are you able to
How
hear
are
me
you?
now? Okay,
Yeah.
great. I'm doing good,
Okay,
sir. How are you doing?
good. So great to have you back in front of wrapping up this year of 2020. If you want to share your screen, it's that green
Yeah, let me
box.
pull it up.
And curious
There you
as to
go.
what's on your radar. Okay.
Yeah, so,
Corporate
yeah,
bonds, LQD.
yeah, this is just like some of the old stuff, but the real thing I've been, I know we talked about last time, uranium. I've really been enjoying the uranium ride the last week. Finally took a year to work out.
A lot of people
But
actually have started talking about uranium lately because it's breaking out from a major formation, right?
yeah, see, I don't follow the technical trade, but the supply side, since
Yeah,
mid
from a technical
2019.
perspective, it looks also very, very interesting.
Yeah, it's
Yeah,
going to
which
be
is
a
good
part of the
because
whole global green energy push. Nuclear reactors, the modern ones, supposedly safer. So yeah,
yeah,
I've heard this at Dem, and you're a guy that put me on to looking at uranium issues, and they say how small like gold and silver miners are, the whole universe. That if you just took one day of IBM's volume and put it into miners, it's like a garden hose that it would just make them blow up. And uranium issues are like a straw, where it takes even less oxygen because doesn't take as much money to move them. The market cap of all of them is not that large, right?
yeah, and
Part
especially
of
in
the
uranium, that
attraction,
there's
isn't it?
yeah, and also a big thing on uranium. So I know a lot of like uranium has an interesting last 10 years, and the uranium like fin Twitter, like financial Twitter, a
Yeah.
lot of them are kind of like fanatics. Like they've been holding uranium since 2000. Fukushima happened in 2011, which
Yeah.
prices collapsed. And I actually I don't want to come off as like another uranium like fanatic, but since 2019 we've seen, so a big thing I like to look at on the fundamentals is the capital cycle, which there's a book by Edward Chancellor. I don't know if you've ever read the book The Devil Takes the Hindmost, about the historic bubbles.
No.
It's a really popular book. It goes over all like the big bubbles throughout history, like Tulip Mania, South Sea, etc. Well, that
Yeah.
author wrote a book. I mean, he was an analyst for a big fund, and his name's Edward Chancellor, and he wrote a book called Capital Returns, and he basically shows how um, there's a strong correlation between the not even looking at the demand side of a commodity, because demand side is very fickle. Like perceptions change. Like investors say, like, oh, China consumption one year, and then it could change. Like COVID happens, and it like suddenly there's like a glut of oil when there was like a tight market before. So
Right.
instead of focusing on the demand side, it's more prudent to focus on the supply side. So for commodities, I always just try to focus on the supply side. And a big key tell is when you see year over year production of that commodity start declining. So for example, uranium, even after Fukushima happened and Japan and Germany started dumping their spot uranium onto the market, uranium production was rising year over year up until 2017. So even as prices were falling, these miners were producing more. And it makes sense. I mean, they spend billions to build these mines, and these firms, from like a prisoner's dilemma, they can't turn off the spigot, even if it's prudent, even if they all got together and said, hey, CEOs are saying like, we can't make money at these prices, or et cetera. Why don't we all, stop producing? It'll push the price higher. Well, one CEO doesn't want to be the one to do that, even if it's prudent, because they can lose market share. And how do they explain to their, other shareholders, like, hey, why did we back off production when everybody's ramping up production and we have debt to service, et cetera? So it kind of puts these companies in a reflexive, like amplifying feedback loop. So the lower prices go. So let's say uranium fell from 60, 70-ish to 20. That means a miner has to produce pretty much 3 to 1 as before just to make the same revenue. So now you have the glut even worse than before. So sorry, the point of that was, so the capital cycle, once there's a big lag effect. So the thesis for uranium in 2011 up to 2015 was like, hey, there's gonna be a deficit problem, but there's a really big lag. So investors started buying years ago, expecting. And one thing I've learned is markets are not efficient as not as efficient as they're supposed to be. So there's a really big lag effect, even though the supply deficit story was here for a couple of years. But finally, in 2017, we saw global production, which hit a record high in 2016. It fell, it's now down like 22% since 2016 peaks. So we're already seeing suppliers now, mainly the marginal producers. Kazakhstan is the world's biggest producer of uranium. Like 50% of uranium just comes from their main mines. They've started cutting back production. Then Cameco, which is in Canada, the world's other largest uranium producer, they had a marginal producing mine called the Cigar Lake asset. Well, that just because of COVID just went off. Well, it was offline, and then they tried to bring it back on, and then they just said, hey, it was a mistake, and they just went back offline. So the supply deficit problem was already looking attractive in 2019 because of the supply side plunging, 20%. But now we haven't even priced in COVID. Yeah. So
focusing on supply rather than demand, it really is interesting. I think that's going to play out in the grain complex too.
Yeah.
Although demand is good, but where's uranium trading right now at Adem?
It's around like 30, maybe 31, which is also a key thing that I find very. I have a chart. Let me.
Yeah, let's see. Sure. Are you glowing? From profits or from uranium?
Oh yeah, big time. Well, because remember when we talked last year, I told you I was buying long dated 1 year out of the money calls on Cameco when it was at like $10. Now it's at 14. So 700-800% higher. Well, see, that's the thing, because that's why I like this roundabout strategy. Is I could just load up on cheap. Like another thing I'm going long the US dollar for long dated with long dated puts on the Euro and the Swiss franc, and it'll probably expire worthless. Like at this rate, people will look at me and they say, "What, are you crazy?" And I say, like, yeah, I actually think the dollar will probably go lower, but on a expected value perspective, the money's to be made if that doesn't happen. We don't have a crystal ball. Something could happen in a year from now. So I don't mind losing like little, let's say I make $1,000 bet on uranium once a year, and then I lose like little paper cuts, $1,000, over a year. That's what, like a little bit less, like a little bit more than $100, but a month in burn rate. And if you lose that, like let's say 5 years straight, so you're down $5,000. It's like little paper cuts, but you're not going to blow up over that. Exactly. But then this year happens, boom, up 10x. You actually, on a compounded annual growth rate, subtracting opportunity costs, you're up 100%. And it's always hard to say, hey, you're betting on a black swan or something. But one thing I've learned is, yes, black swans are rare, but they're not nearly as rare as the implied volatility and the market's price in. You know what I mean?
Yeah.
So, but yeah, I'm sorry. So
keep going.
So no, that's just one thing I've learned is like the money and the markets is made on that delta where expectations are and where like reality hits. But the problem, I've had a lot of people say, like, I have one friend who's an analyst and he's like, oh, I don't get it. He's like, profits on shippers, everything are down, but their stocks are up 50% year to date. Like, how is this possible? And I'm just telling him, like, the more the banks ease, it allows these big funds to roll their positions over. And like these investors and hedge funds are betting on a far distant future. Like they're like, yeah, the data sucks today, but in 2 years from now, it'll be better. So these stocks are considered cheap, thinking what, they could be. Now, I don't believe that, but I mean, a lot of these big funds, that's how they're playing it. They're just rolling their positions over, because if the bank can keep liquidity low, like Greenspan in the 90s, he was like, I'm just going to keep liquidity real low so that investors don't have to dump their positions and, send the market tumbling. So they can just keep rolling them over, keep liquidity going, bids find the asks, vice versa. And until there's something really big can happen, like the COVID. But, then there was like, 2000, the 17 volatility suppression. Then there was like the 2019, remember in December or the winter, the Dow fell like 20%. So my thing is that these big crashes that are like not supposed to happen, they actually happen way more frequent. There's actually a big thing I like to look at on the VIX. So when you look at the VIX, you can kind of see how, are you able to see my chart on my page? Okay, cool.
Got it.
So you see how it kind of goes low, and then all of a sudden it's like a big volatility spurt. It goes boom, boom. But this is just the last 5 years. So if someone was just buying long dated 1 year calls on the VIX every time it hit 10, once every year, theoretically, if you survive or if you got them cheap enough, you'd make a ton of money. Also, like this, like all of a sudden, VIX hit an all-time high, I think. Yeah, COVID, or near an all-time high. It just shows like how Nassim Taleb, the author of The Black Swan, and he wrote a book called Anti-Fragile. And I think it's really important because he said, instead of being hurt by big black swans, like blowing up, do the inverse of it. Use a little bit of money to like tail hedge, buy puts on positions that may seem, like volatility. You could just buy like every year 1% of your portfolio on calls on the VIX when they get really cheap. And then something like a black swan happens, you can make 50x on that, $1,000. So, you know what I mean? Then all of a sudden it justifies the cost before. And I hear a lot of people say, yeah, but you don't know what'll happen. Like I remember a year before this, I was buying calls on the VIX when they were at like 11. And this guy was saying, yeah, but you're going to lose a lot of money on the options before that works out. And it's like, yeah, that may be true. But historically, from all I've read and everything I've working as an analyst in the past, humans are biased, and we have a thing called recency bias. So when things feel good recently, we think they're always going to be good. Exactly. And then the market prices that in. So you take advantage of those biases and you look for the positive expected value. And that's a term by Michael Mauboussin. So I like to combine all those things because there's a famous sociologist, psychologist, Daniel Kahneman. He wrote the book, I forgot the name. It's a very important investor psychology book. I totally forgot the name of it, but the author is Daniel Kahneman, and he came up with a thing called prospect theory. And that is humans feel losses about 2.5 times more than equivalent wins. So investors, even if, actually, I'll just pull up a chart of prospect theory.
That's interesting. So they're more wounded by the losses than they are healed by the gains.
Yeah, exactly. So on this chart, if you see it right here, so an equivalent gain of, let's say, 100, a loss, I mean, it's not symmetric. So a loss of 100 is equal to a $100 gain. It means the losses are felt more. So a $100 loss feels 2.5 times more than making $100. So that's why we always want to be right. That's why, we a lot of people confuse, and Nassim Taleb brought this up wonderfully in his book, and it really hit me. He said, profit and loss isn't about being right or wrong. Some of the best investors in the world are the worst forecasters, and the ones who are supposed to be the best forecasters are the worst investors, because when people bet on what they think is right or wrong, isn't what's going to happen in the future. So, for example, on prospect theory, that means people want to have those small equivalent gains, even if they risk blowing up. Like, we've seen Victor Niederhofer in the 90s, long-term capital management, all these subprime things. It's like they'll make those small, 20% year-over-year gains, which, relatively big, but they're doing it with so much leverage that if one black swan happens, they blow up and it can almost take down the world with them. That's what happens. And so when investors bet what they think will happen in the future, it's because they want to feel like they're right. And they like feeling right. For instance, like I don't like watching my uranium calls expire worthless year over year, but it sucks to look at. But then, a big event happens and boom, you're up 5-10x in a few days. And yes, it's rare, but what I'm getting at is, so on prospect theory, it just means that humans are they feel losses more than equivalent gains. So we're loss averse. And when investors have that psychology into investing, that means they want to go with what they feel is right, even though that isn't necessarily the best investment. So another way I would look at it is, like I was saying, I would bet against the US dollar at this point, and not because I think the dollar long here is a great play, but because it's already priced in low, it's overcrowded. Yeah, it could go down further, but the huge gain going down now isn't as it was, a year ago betting against the dollar. So at this point, the expected value is if something goes wrong and let's say deflation hits, or the ECB or the BOE or the BOJ, they all out ease the Fed, in the next year and sentiment changes, then all of a sudden you see the dollar soar versus the euro and the franc, just, for example. And then that's where like, the big gains will be made because it's not priced in today. So I hope I didn't,
No.
lose you on a bunch of my ramble.
I respect and enjoy your thinking.
So, I appreciate it.
Yeah. So, and I learn from you every time you're here. So, interesting about, how losses really scar people, probably also affects their future decisions because they don't want to feel that pain anymore.
Exactly. And it makes total sense. Like one thing I've learned is like I have people who are friends and like I consider myself a contrarian investor, and I'd say like you are as well, and a couple other people I know that but the crowd isn't. And I have a good friend of mine. He's like, Adam, I don't get it, man. Like my stock's going down, blah blah blah. And I tell him like, dude, when you're contrarian, it hurts. And you kind of want to look. It's like you're being a rebel. Like you lose more than you win, but you want your losses to be really small and your upside have unlimited room to run. So like long dated options, buying long dated options instead of selling options. Selling options, you're taking a little bit of money, that's small equivalent gain,
Right.
but you risk imploding yourself if you don't, if they're naked options, especially. Like you can,
I've seen it.
Quick. Yeah. And it happens way more often, than many people realize. And because see recency bias, you're like, oh, that it doesn't happen that often, but it actually does. And so one thing I told my friend after I learned, like after doing this like years, you can tell somebody about contrarianism, but you have to be, and you can tell people about economics and capital cycle and etc. But you have to be born a contrarian. You have to have that mindset. You know what I mean? That you can look at your losses, losing money or betting against the herd. And I have like some friends, and I realized later, I said, hey, you shouldn't be doing this because it makes you sick. It makes you uncomfortable watching those little losses happen. So, just, do what makes you sleep at night. But, my opinion, I would also say use a little bit of your money to buy portfolio insurance using, optionality.
Yeah, people are saying that's a waste of money now. And so,
when premiums are high, yes.
Yeah. Yeah.
So after COVID, I wouldn't be buying, VIX
right.
or optionality, but when it settles.
All right. The other two most crowded trades, Stelios, my partner here at ForexAnalytix, said besides the dollar is Bitcoin, it's crowded, and the stock market, euphoric and crowded. You doing anything there?
I'm waiting for the VIX to go lower before I, load up on my anti-fragile trade.
Okay.
But yeah, I mean, I
have a number in mind, like 18 again or 17.
I personally I like it below 15, just because I feel like, especially with how much volatility suppression. But just so any of your listeners know, that's just an arbitrary number. Like honestly, there's no reason. I just, from the history I've done on the VIX risk reward, I find when it gets below 15, that has the most upside within like a 1 year time span. Like usually there's some kind of event that happens that shakes the VIX higher than 15, where my puts won't expire worthless. I mean, I'm sorry, my calls.
Okay.
And I think the market will probably get hit. Something will happen. I think the global reflation trade is overbought. I mean, we have China and Europe. China just reported year-over-year decline in CPI for the first time since 2009. So they're having they're exporting their deflation. If you look at the PPI, the producer indexes, I was actually just looking at them. Yeah, the European. This is the price. Where's?
Oh, there's Art Hogan.
Right.
An old guy like me.
China PPI. So if you look at China's year over year, PPI, as you see, they're exporting their deflation. So China's last 5 years. So you see, every time there's been like a big downturn in markets or like, weakness, it's China pumping their. Last time this happened bigly was in 2015-16. And then China remember they did their big devaluation.
Right.
And then markets collapsed. So, things were going good for the first, 2017-18 cycle with the tax cuts and everything. But now Euro is the same thing. It's negative PPI. So there's a phenomenal book I just read by Michael Pettis and Matthew Klein. It's called Trade Wars Are Class Wars. And that book I highly recommend it. Just came out in May, but it basically shows how China and Germany, Japan, big surplus countries, are suppressing their consumption nationally to force big surpluses because they have to export the excess because they can't consume it all at home. So for every surplus nation, there needs to be a deficit nation. But the big thing after 2008 was that China was supposed to take over. Remember that demand for commodities, everything was, hey, China is building these big, so after world demand collapsed in 2008, China didn't want to deal with unemployment and weaker growth. So they exported it abroad. They were dumping their deflation onto the rest of the world with their low cost, goods.
Labor.
And now the problem with it is, China's consumption to household consumption to GDP output ratio, it's like 40% of GDP. It's the lowest of any major economy because they keep it low on purpose, meaning that the other one that keeps it high is exports and investments. But the thing is, China's run out of positive returning the low-hanging fruit investments. Like they can only build so many apartment complexes and malls. They've already built they've already taken off the low-hanging fruit. So
Adem, is that why they have that policy? It's called, I believe, called clean plate policy, where they're not giving them, it's almost like a they're practicing for famine by giving people less food and training them to consume less in the food arena.
So so Michael Petty, there's the Hoku system. They have very poor social benefit system. There's like a lot of things in China that suppress consumption, because when you suppress consumption, you're increasing savings, and when savings is higher, there's more investment. So historically, the book goes into historical countries like the Soviet Union was a big example of harsh high savings model. So they have to force consumers not to spend, and they did that by, like, for instance, the Soviet Union was exporting, millions of pounds of grain to Europe during the 1950s, while they're in the 20s to the 50s, while their people were starving at home because the government had to sell that exports to raise capital to build their industries at home. So they had a very powerful military by exporting grains from their farmers that the farmers weren't allowed to keep, and people were starving to death in their own country. So that's an extreme model of the high savings model. Another good term for this, that China model they use, is it's called economic backwardation, and it's called the Gerschenkron model, and it's named after an economist, Alex Gerschenkron, and he wrote that countries usually third world countries, poor countries, have to force their savings rate higher. And the thing is that the government, does they build big ports and big investment structures to stimulate growth and employment and et cetera. But eventually they have to rebalance. So China was supposed to give more consumption. Like America was trying to force them, hey, you're a currency manipulator. Hey, you're, all these things like protectionist tariffs. The trade deals, bilateral trade deals Trump tried to do is try to get their consumption higher at our expense. But China's been fighting against it because it'll get rid of their surpluses, which means their dollar, their hoards of money. And their household consumption has actually declined since 2008. So that means they're forcing that excess on the rest of the world. And it worked fine up until 2008, when the rest of the world's growth slowed down as well. So now they're just dumping excess onto a already indebted and anemic world. So that's why with everyone talking about global reflation, I don't think you can talk about reflation until China or wages at home start rising. And wages have been, since the 1970s have been, there's actually a really good
so you're still
report.
in the secular deflation camp.
Yeah, so I look at deflation
except for uranium.
So
special situations,
price changes. Yeah, well, so there is inflation every year, obviously, even if it's 1%. And last time I know we were talking about this book, I read The Great Wave, and it shows price inflation since the last 1,000 years. It's a really good book. I recommend it. It's called The Great Wave by David Hackett Fisher. He's one of the best historians, but he showed since 1100 AD, there's been big price revolutions, he calls them. There's been 4 big waves of when inflation got out of control. And in those periods where inflation out of control, you had Napoleons, you had uprisings, you had the Florence Empire crash, Spanish Empire crash, basically during periods of inflation, there was the Great Plague, blah, blah, blah. Horrible things happened. And then there's a big deflation period. Like the Great Plague was one of them. The bubonic plague, it like wiped out 20% of the population or something. So workers class, people who collect wages versus rentiers, the capitalists, were, had the power to negotiate better wages because there was less workers and et cetera. And but so the point of his thesis was, even if there's inflation like today, like 1 or 2% a year, it's still there. Like I believe there is inflation in the sense that, it's being devalued, but it's not like we're going to the grocery store and we're like, hey, there's, prices are 50% higher of all my goods I buy than last year. We usually go, hey, when I was a kid, or hey, like 10 years ago, I feel like I used to get more. It's like a slow devaluation, but eventually,
invisible, almost invisible. Yeah.
Exactly. But that's the thing, that even if it's inflation 1% a year, over 50 years later, that's a 50% decline in your purchasing power. It gets to a point, like a tipping point, when it becomes noticeable, and it's like, hey, like, prices are, this is weird. And he shows, David Hackett Fischer writes how back in the 1100s in France, there was like a big once a year festival where producers would come and everybody would come, and artisans, and they'd sell their goods. And it first happened there, whereas after like 30 years of doing it, it was like he said inflation was like only 1% a year average, but just that 1 year, it became so noticeable after 30 years that producers were like, hey, prices have really devalued, et cetera, that they started raising prices. And once the producers start raising prices, it starts trickling, higher, like spiraling. So if there's one thing I've like not, I mean, who knows, what I know, but one thing I've seen is that for inflation to pick off, we'd really need to see wages increase, indebtedness go down. And I think since COVID, I mean, they're just pushing rope at this point. Like money velocity is falling, wages aren't really growing. It's really hard to see how that money is going to pick up into the system unless there's a big marginal buyer. And I think the one thing the government did is this time, since 2008, I'm not really big on the fiscal side because that's temporary and it's not as big as an aggregate as it was when Keynes recommended it in the 30s. Like more people were doing ditch digging and, road building back then compared to now. Construction workers aren't the marginal, middle white class producing job anymore, like those kind of industries, like union workers. Right. So we're in like the digital age now, where since the 1970s, there's actually another great book, but there's a great book called The Rise and Fall of American Growth. And the author shows that basically the first two big spurts in the US or in the world, Britain too, over the 1800s, and were the first two industrial revolutions. And since the 1970s, we've exhausted the marginal gain from those. For example, when we made electricity or plumbing or whatever else, cars, it had to proliferate through the economy. But since the 1970s, that doesn't work anymore. Like the marginal benefit doesn't work for the average producer anymore, meaning that the marginal gains from the third industrial revolution aren't being passed on to the worker compared to the others. And there's an easy reason why. We're in the information communication age, digital age, meaning it's not revolution anymore. It's just evolution. Like that phone I'm buying now, like a 10th gen iPhone, is like slightly marginally better than a 6th gen iPhone. It's not as much as like, hey, we have to go install a new telephone in 200 million homes, or we have 200 million cars. It's like, oh, am I going to buy a 2019 Nissan, or my 2015 is fine? So it's all evolution, just smaller tech, and it's not proliferating like it used to, which is a big chokehold on demand.
What's next? What's going to drive it?
I think we're going to see a lot of universal basic income talk. I think because we're going to have more quote bullshit jobs where people just feel, these jobs are kind of meaningless, but the governments like France and China just pretty much employ people to keep them happy. I think we're going to see more of those kind of like remedial jobs, and they're going to start pushing more universal basic income. Maybe they'll start, like, as people go more into AI, they'll start taxing corporations for the AI to like pass on to people. I don't know. There's a great book called The Great Rupture by Victor Schvetz. He was a very famous macro analyst. He just published his book. I recommend, you checking it out. He goes pretty big into, how marginal capacity has declined and how, it's kind of a bleak outlook, but I don't know.
While I have you on book titles, Barry would like to know the name of the author of Trade Wars again.
Oh, it's Michael Pettis. He also wrote the book, The Great Rebalance, which focuses pretty much on China's consumption to investment problem. And he wrote the book, The Volatility Machine, which is like one of my favorite. It's like the best macro book, one of the best macro books in my opinion. Super underrated. But yeah, Michael Pettis and Matthew Klein wrote Trade Wars or Class Wars.
The power of reading, the thirst for knowledge exemplified in my trading warrior brother, Adem Tumerkan. Really, you are. And, I want to wish you and your family, great holidays, and stay healthy, buddy. And we'll do this again next year. I really do appreciate your presentations every time you come in here. And it's almost like I feel energized by just listening to you, because I could feel your passion for what you do. So
absolutely, man. I mean, thanks for having me. And I always like speaking with you and everything. It goes by really fast.
Yeah, I'm telling you that you're one of the more better read people I've ever interviewed, and your ideas, be a great guy to have a few beers with and talk about this stuff. And who knows, I'm glad for now, at least, our paths have crossed on Twitter, and that you're a regular on Face now, Adem. Thank you very much, buddy.
I appreciate it. Thanks for having me, sir. And same to you. Hope you guys all have a great holiday.
All right, buddy. And good luck on your dollar bet. I actually, well, maybe I shouldn't say I agree with you.
Well, oh yeah.
All right.
Who knows? But take it easy, Dale.
All right, buddy. All right, everyone. You can follow Adem at Radical Adem. I believe there's no hyphen or anything on it. And go to his website, speculatorsanonymous.com. So there it is, Radical Adem, and check out what he has there. So that's going to be a wrap, everyone. We'll finish the week off. Oh, no, today's Wednesday. I almost did what Kevin did today. So I'll see everyone tomorrow. And also, we're going to have Michelle Schneider at Market Minute. And enjoy the rest of your day. Adios, everyone. Don't forget, don't just count all the books that Adem has read. Count your blessings. See everyone tomorrow. Adios.